Inflation is no longer falling. In fact, it is moving to the upside and more aggressively than expected.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk.
All right, everybody, welcome back to another edition of the Daily Dots. Here on Thursday, the last day of July. Summer is absolutely flying by, as is the quarter, as it turns out. Chase here, flying solo with you today. Got a few things to talk about. Going to go through the markets and then cover a little data and then some interesting things that are sort of top of mind for me, at least. The S&P was up over 0.5% at one point. We closed down 0.37, so another kind of some intraday ugliness there. The Qs finished down about 0.5%. Small caps down 1%. Equal weight down almost 1%, down 0.9. Mag 7 up 1.3. We'll kind of talk about that a little bit. All world ex-US down 0.86. And that is, again, in part due to the dollar, which is now back over 100. You're up 0.19 on the day. Bitcoin down about 1%, currently at about 116,000. Oil finally had a down day, back under 70 at 69.41, down about 1%. Gold down another 0.2, silver down 2.5%, platinum, palladium down almost 6 and almost 4, copper down 20.6%. Being long copper vol turns out to be the trade of the month. As far as yields go, pretty flat. You're up about 1-2 basis points on the 2-year, and then literally flat for the rest, although you were down like 2-3 basis points at one point. So that was kind of notable. Intraday kind of came back on yields at least. Vol ended up being up about 0.3 on the day. So front month VIX futures are just under 18 now. Kind of the big story of the week, big tech earnings, which has been mostly good, but as we stand here, not all good. Obviously, we had Tesla come back out with another poor showing, but then we had Microsoft super strong. Google was good. Meta super strong. Meta closed the day up 11%. You had what looks to be solid numbers coming out of Apple today. Pretty significant revenue beat there. iPhone beat, like their China revenue beat. And that's up about 2.4% after hours as we record here. And then you had on the bad side, Tesla and Amazon so far, like just not as good. Amazon's kind of forecast moving forward was bad. I mean, part of it is the massive AI capex hitting earnings, hitting profits, but I mean, it's a little weird to see them get hit for that because they're kind of all doing that. If anything, Meta is going all in on. They're just going to throw basically every dollar they have at trying to win the AI battle, and I mean, we'll see what happens. They're willing to spend anything for talent, and they're willing to essentially spend anything for infrastructure. So it's going to be interesting to see how it goes as this becomes more and more of a perceived winner take all thing. It kind of tells you whoever does wins a lot. And then the 2 to 4 companies really competing for the giant foundation model stuff, like whoever doesn't win will just kind of have had a monstrous pile of capex for nothing. Now that assumes it is winner take all, and it may not be. It may just be a thing where everyone does it and makes a bunch of money. Who knows? But I thought that was just worth noting. As far as July goes, we finally had an up month for the dollar. It was actually the first up month since the election for the dollar. And as I mentioned before, the first half of the year was the worst first half for the dollar since about 50 years. So interesting to see it kind of popping back up here now in July. And we're starting to see that being felt and some overseas equities and in some commodities. I mentioned before, copper is an idiosyncratic thing, and that also partially is to blame for why platinum, palladium are down, but platinum definitely getting hit pretty hard. Silver getting hit pretty hard all of a sudden. Um, a lot of even like rare earth stuff and just adjacent, critical minerals like have not been very good lately. So this dollar move starting to matter in those ways. I want to talk a little bit about data. We got the PCE data in today. So we got just as a refresher too, we always hear about the Fed's 2% target. What I think a lot of people don't realize, even people in the industry, is I think it technically is talking about headline PCE. So not CPI, not core, anything, just headlines PCE. And that number was higher than expected today. People were expecting to go from 2.3 to 2.5. We went from 2.3 to 2.6. So inflation is no longer falling. In fact, it is moving to the upside and more aggressively than expected. And obviously 2.6 is, a good ways from 2.0. And to me, of particular note in that PCE print is the durable goods number. And that came in at 0.9% year over year, 0.93 to be exact. That sounds low. The thing is, if you go back to May of last year, it was -3. If you go back to the time of the election, it was -1.2. And it historically, globalization makes goods cheap, right? Historically, that number is pretty flat to negative, consistently over time. So to have it all of a sudden being like kind of up 1%, it starts to lean on a lot of the disinflationary pressures we've had, kind of since the crazy blow off of inflation 21, 22. So that to me, that's starting to get notable. Like it's the highest since December of 22. So you're talking, almost 3 years, a 3-year high for durable goods inflation. And obviously the reason I'm paying particular attention to goods inflation is because that's where you see tariff impacts start to hit inflation. But of note, like the services number, services is still driving almost all the inflation, and that was actually a little higher than expected. I think wages may start to firm up here. We've seen the Dallas Fed did some work showing where basically labor in Texas is really tightened up, and they're having to offer higher wages than expected. Again, going back to immigration, like in Texas is obviously more exposed to net immigration than most of the country, given being right on the border, et cetera. But for them to say all of a sudden like, oof, wages are starting to go back up, and it's difficult to find people, and they're making people work more hours. Like the labor market is tightening up significantly in Texas and quickly. And it won't be the only state. It's not going to just be the border states. That will push out into the rest of the country. I don't know how fast, and I don't know how hard. I obviously don't know what the immigration policy is going to be, 3 months from now, but forget, 2 years from now. But if we stay status quo with the sort of quota system they're running for deportations, that immigration does become a significant tailwind for wages, which becomes pretty inflationary pretty quickly. Is that will bleed into services inflation, while we at the same time have tariffs pushing up goods inflation. And this all, we're at 2.6% inflation with absolutely no energy problem. Like we have energy deflation right now on a year-over-year basis. So again, what is PCE if we don't have energy deflation? 3 already? Like just something to keep in mind.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
For data tomorrow, we obviously have the jobs report. We also have ISM, construction spending, and auto sales. As far as the jobs report goes, the expectation is for 104,000 jobs being added and 3.8% for average hourly earnings. Think of it as, essentially wages. Speaking of, we had the employment cost index that came out today. That's only done quarterly, but it is the Fed's favorite metric for wage inflation essentially. And it beat expectations. It was expected to come in, I think, at 0.7 quarter over quarter or whatever, and they came in at 0.8. So I think wage inflation is a very underrated thing to be looking at right now. And I don't think a lot of people are paying much attention to it, and I think they should because of what it can do to broader inflation. But the other thing we're expecting tomorrow is for the unemployment rate to go from 4.1 up to 4.2. And again, going back to net immigration. Now, I mean, obviously, it's easy to see that. If you look at things like the labor differential from the conference board, it should absolutely be 4.2 or 4.3 or 4.4 even. But with the net immigration thing going on, it's hard for the unemployment rate to go up while we're still hiring people. So watching that 4.2 to see if it stays 4.1 will be interesting for the kind of this, hey, what do wages look like in 6 months kind of idea. As far as the jobs number itself goes at 104 expectation, I said this earlier in the week that I thought it could beat. Then ADP beat in a meaningful way, and it kind of it's weird, but it scares me and thinks it won't go the other way. But some of the modeling I've seen from some people that follow this stuff close have us beating 104. So we'll see how it goes. What I do know is if you do get a beat to the upside, let's say you get 4.1% unemployment and 130,000 jobs or something. Not to mention if wages come in at 3.8, 3.9. Then I would expect bond yields up, dollar up, probably a problem for equities at that point. Equities look a little tired lately in the last 3-4 days. So I think if the dollar were to kind of rip another 0.5% plus, and let's say the 10 years up 5 basis points plus, like I think that would be, I don't think stocks would take too kindly to that, especially now that we have most of the big tech earnings out of the way. Got a lot of juice for that, obviously. But we'll see. The other two things I want to talk about, obviously, gold's been a big story for us in the last, call it, year, but our year-to-date performance, a lot of that has come from gold, silver, gold mining shares, things like that. We are starting to see some headwinds there. I mean, obviously, the price has gone up so much so fast that it deserves it to cool off no matter what. But you're starting to see like a real fundamental case for it to potentially keep cooling off, and that is central bank buying, which for us is like we view it as the number one driver. Like obviously, high debt deficits, monetization, debasement, like all those things make gold go up, and all those things are going to keep happening, which means gold's going to keep going up. But it's not going to go in a straight line. It's going to have pullbacks. What would be the number one thing that could cause a pullback? Well, central banks kind of sitting out for a little bit. And we see this quarter versus last quarter, central bank buying fell by about a third. And if you kind of see it on a chart, like all the quarterlies going back like a decade, you see that, like, in the last 2 years, we have been way above normal. And now all of a sudden on this quarter, if you kind of look back to your left on that chart, like, okay, well, now we're kind of back to a normal area where we've been for the last decade. So it's not like a extra demand from a central bank this past quarter. Now, it's just one quarter. Who cares? That may mean nothing. It may be totally tied to the dollar going down and people needing less reserves. It could be a lot of things. Central banks sitting out buying for no other reason, then it got expensive and they don't want to deal with that. Like, there's a ton at play there. All I know is if you look at a daily chart of gold, it broke the most recent, most aggressive, like multi-month trend line. And then to see that follow up with, central banks kind of backing away a little bit, just suggests to me we can keep pulling back, especially if the dollar and rates keep moving higher. And the last thing I want to talk about was China a little bit. I wrote a piece yesterday about this. If you remember back in kind of December, January, I started talking about how bullish I was on China. And literally this whole thing came about for me because what I saw was the willingness to use fiscal stimulus for the first time since Xi Jinping has been running China. They're doing that, and that has led to significant outperformance of their equity market over ours for the last 6 months, the last 18 months. But I still find global investors aren't particularly excited about it, and I still see all these calls for like, oh well, China's going to be in bad shape until they rebalance the economy more to consumption, more to like trying to help out consumers, more to backstopping the population. Because the reality is, for the last, whatever you want to call it, 30, 40 years, they've essentially sacrificed labor and given all the gains to capital. Like they make sure that you don't, the regular people's quality of life does go up, yes, but that's, it's been more about producing things, exporting things, building things, and one of the ways to do that is to take most of the capital along the way, and that's what they've done. But you reach a point where their exports and their share of exports and their production versus their consumption are truly out of balance. Like it's too much. You know, it's bad for them. It's bad for the rest of the world. Like obviously, it's bad for their current trade relationship with the entire Western world. Not to mention even the rest of the global South and emerging markets don't appreciate them competing with them on everything and winning on price and exporting other deflation and taking market share in essentially everything. So like that is the popular way of looking at it, is like, oh well, until they do something about that, like they're not really going to be able to get out of this middle income trap and become like a true modern economy, etc. And I read a piece just today that Ambrose Evans Pritchett from the Telegraph wrote, where it's all along the same lines, same, nope, totally unbalanced economy. They don't care about their consumer at all. She never will. But the reality is they do, and they're making significant moves along these lines. We're seeing direct stimulus now. To this point, this last program is directly to incentivize people having babies, to mail them a check for that, tax free, the whole 9 yards. It's not a ton of money, but it is money. It is a direct stimulus to a section of the population, which to me, that's a huge deal. It's not the kind of thing they've wanted to do. And if you actually look at their government spending, it's up 3-4% year over year. So again, huge deficit expansion, which is why I got bullish. But if you look at it, growing even faster than the basic, government spending jump is spending on education, on employment, and on Social Security. That spending is up 6.4% year over year, and that number is even higher than it sounds because they have deflation in China right now. So in a deflationary economy, they're spending over 6% more on what Xi Jinping in the past has called welfarism. He's preached very vehemently against it. Like once you start spending on that, it just always goes up. People become dependent. Like he's not completely wrong, obviously, but at the same time, the money they spend on their population versus most developed countries is crazy low. They have a giant animal spirit problem, a capital market problem that giving money to regular people helps them solve. Plus, if you produce a bunch of stuff and the rest of the world starts to kind of stiff arm some of your overproduction, the natural thing to do with your production is to turn it from being external to internal. Like if nobody in the US is going to be allowed to buy a BYD, well, you may as well sell it to your own population. And that's just one example using a car, but there are much better examples of all kinds of other things that the rest of the world is starting to kind of push back on, at least a little bit. And if no one wants your steel, all of a sudden you got to find a new way to use it, in your own country. And I think they're doing that more and more. Xi Jinping and the Politburo, both in the last week, have gone out of their way to talk a ton about more consumption, more domestic demand. And in the past few years, like you've seen them talk about it here and there, and then you go look at the numbers and you're like, okay, well, yeah, but they're not actually doing anything. This year they're talking about it even more and even more like strongly, but they're also doing something about it. Like there are new programs, they're spending the money. There's very direct ways of helping out households in multiple different ways, whether that's sort of a cash for clunkers program for not just clunkers cars, but appliances, you name it. Like there's a lot of direct stimulus that And I read all these analysts and investors from around the world, even in China, that don't seem to appreciate what's going on there. That there is all of a sudden a surge in money going to the population. And the reason that's important is because the two things they haven't done for the last 20 years, or 10 years, is direct stimulus and higher fiscal deficits. It's just been, let's see how much stuff we can make and build. And now all of a sudden it's, sure, let's keep making and building stuff, but let's also prop up the population. And then for the last decade, it's like, who cares about what equity markets are doing, what our asset prices are doing? There's a very clear focus on that all of a sudden of let's get asset prices up. Let's make sure that companies sitting on giant cash balance sheets put those to work with, buybacks and dividends and investment. If we have 50 EV makers and they're all having a giant price war and it's becoming deflationary and it's becoming counterproductive and overproductive, like they're starting to do something about that, like trying to go from, over competition to a level of competition that's more healthy, while we kind of do the opposite and have under competition. So I'm seeing a lot of policy changes here in 2025 as expected that fit the thesis I had 7-8 months ago. And I think it's going to continue to drive very solid Chinese asset price performance. I think if the dollar keeps moving higher here and U.S. rates keep moving higher here substantially, the U.S. will absolutely be outperforming China along that way. But what I think becomes a more kind of interesting metric there is like China versus, ex-U.S. equities as a whole. If it can just kind of beat those along the way, same with South Korea, which I really like a lot. If they can just kind of beat that ex-U.S. equity universe for 2-3 months or 8 months, whatever we end up being with this dollar kind of bull rally. Once you get that next turn and the dollar lower, then all of a sudden they can, they go from just beating the rest of the world to beating everything. Assuming they keep all these policies and they keep, growing and doing okay. But there's something that was just sort of top of mind for me, is the Chinese. I mean, just I hate to say it, but solid policy mix in a way that they haven't had for a decade. But we'll be back with you with more tomorrow. That's all I have for today. And again, remember we have jobs, manufacturing, ISM, construction spending, and auto sales tomorrow. So big day of data. We also have UMISH, big day of data, some more earnings coming in tomorrow. We'll know a lot more about the economy and where it's heading. And as mentioned at one point, the equities do seem a little heavy up here all of a sudden. So if we have a hot jobs report, look for problematic price action potentially in equities as a whole. But that's all I have for today. I'm back with you tomorrow to wrap up the week. Don't forget, you can download, subscribe at knowyourriskpodcast.com. And if you want to see my face, go check it out on YouTube. And I guess we're on Instagram and some other stuff too. So go find it all. That's it for me today. Cheers.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.